Hey, so are interest rates actually going to get lower? I mean, that's a consensus, right? That's a speculation right now. There's a lot of people talking about the possibility of interest rates actually going lower. So, if that's actually the case, let's delve into this, and I think you're going to find it pretty interesting. So, in case you haven't heard, the US credit rating, right? Our US has its own credit score as well too. It took a turn for the worst last week. So, credit ratings agency Moody's actually took the controversial stance of lowering its credit rating to negative from stable. Now, this was due primarily to the large fiscal debts and decline in debt affordability. And obviously, this is a move that's been widely criticized by the White House and received an immediate disapproval by the president himself, Mr. President Joe Biden, and his administration team. So they are not pleased at all. So what exactly does this mean? How is this going to impact us? Who the heck is Moody's? Right? Let's talk about all this here. So the move follows and so what Moody's actually did, and as I mentioned, Moody's is a credit rating agency. They downgraded the U.S. right from stable to negative, right, which is obviously quite concerning. Now this move follows a rating downgrade for the U.S. by another ratings agency known as Fitch. And this happened this past year. Now, this issue is pretty serious, guys, and I want to spend a few extra minutes on this. I want to kind of get into the inner workings of what exactly these credit rating agencies are and who exactly they are and why they do what they do and why all this is actually important to us on the grand scheme of things. And I can assure you that no matter how we look at this, and obviously this is going to be concerning for all of us, but believe me, the president himself and his entire team is quite concerned and they're not thrilled about it for a bunch of reasons. Now, the timing couldn't be worse, right? With all this that's going on. People grappling through, umpteen number of financial problems, dealing with high interest rates, high inflation, sky high prices for food and gas. I mean, we can go on and on and on about how the cost of everything is pretty much going up. I mean, we just went for dinner last week, and literally 3 out of the 4 tables that were around us were pretty much all talking about the high cost of food these days. On top of that, there's a whole geopolitical mess, right? That's going on with Russia and Ukraine, not to mention the ongoing turmoil that's happening in the Middle East, right? And now, it also seems like, and in case you haven't been following, but it seems like there's a lot of other countries that are kind of teetering on the edge of war as well, too, right? So that's quite concerning. Now, let's not forget, there's also something very, very big that's happening right around the corner, and that's a 2024 presidential race, right? So I'll tell you right now that both Democrats and Republicans, they don't want to step into that with a track record showing any kind of financial weakness. That would be pretty bad. Now, people on a whole, Americans on a whole, are tired. Okay, they're tired. They're tired of the same old, the nonsense, all the crap that they're being fed every day on a stick about how don't worry, things are going to get better and better and better. And, well, it seems like things are kind of getting worse. Having said that, people on a whole want their country to do better, right? Obviously, for many reasons, and I'm sure that the parties involved in running the company are doing what they can as well too. So let's see, right? I mean, at the end of the day, people are concerned about things that are important to them, that are near and dear, and with these sky high prices that are talking about with food and gas and everything else in between. I think that's really important, and I think it's time that something is done about it. And they want the country obviously to lower cuts. They want the interest rates to go down. They want inflation to go down. They want their purchasing power to increase again, because right now a lot of people are having a very, very difficult time doing anything. But guess what? There might be some good news around the horizon. Yes. We can all use a little bit of good news these days, and I'm hinting at the possibility of interest rate cuts happening relatively sooner than later. So let's kind of delve into that here a little bit. So, in layman's terms, how does this all impact us, right? I talked about all these different things that we're talking about here, some of you are probably not even aware of what Moody's or Fitch or what all these credit rating agencies are, and how on an overall, like how's that going to impact us, right? So let's just kind of recap a little bit about what just happened in the news, and then I can kind of transition you into to what it is that I'm trying to talk about here. But you recently, I think we're all privy to the fact, and I made a video on this, but the Republicans, led by House Speaker Mike Johnson, new House Speaker, that is, and of course, the Republicans control the U.S. House of Representatives. They came up with a temporary spending measure, and all this was in aims to avert a partial government shutdown. And they achieved that, and they were able to work with the Democrats and come to the table and come up with this a way to potentially avert a government shutdown. And that's fantastic. That's news to all of us, and that's exactly what we want to hear. Now, ensuring that, obviously, this was in aims to ensure that all the federal agencies and services and programs continue to remain open and operational, right? So that nobody's impacted negatively. And of course, the markets weren't impacted, and nor should they be impacted. But this is just kind of like an interim, kind of like a temporary fix. Like, imagine putting a Band-Aid on something. That's exactly what this is, because this should maintain financial stability, at least for the interim, for the nation. And thankfully, avoiding a government shutdown shouldn't be taken lightly at all, and nor am I insinuating that you are, but it's important to understand that we're going to have to go through this whole mess all over again in the new year. But that's more to come on that. So now let's break down Moody's, right? You heard me talk about Moody's and Fitch, and what the heck is Moody's? Moody's is a credit rating agency, and they lowered the U.S. credit rating, okay, and I mentioned to the president's dismay. And Moody's is as a credit rating agency, they examine various different factors and look at a number of different things for them to be able to determine a country's rating. And so when we talk about a country's credit score, just like your credit score and your credit rating, well, countries have their own. It's called a sovereign credit rating. Now, when it comes to nations, there's like many different credit rating agencies that are in operation, but there's three main credit agencies in the game, and that's Fitch Ratings, Moody's Services, and S&P Global Ratings. Okay, now sovereign credit rating essentially judges a country's credit worthiness, assessing the risks associated with lending money to the government. Now, investors often buy government issued bonds, all right, as a way of lending money to a country. Now, these bonds are usually seen as low risk investments, but some governments are perceived as more or less likely to meet their financial commitments. Now, that's a possibility, and that's a risk that obviously everyone kind of has to go through. But having a higher credit score is obviously going to mean that, it's going to show that country's credit worthiness as being very, very strong and competent. Now, recent concerns about federal spending, political polarization, and all the geopolitical turmoil and issues that I was referring to has not helped anything. In fact, it's made investors a lot more weary and quite nervous, right? So this all led to kind of like a sell-off, right? Causing U.S. government bond prices to hit their lowest levels that they've ever been in the last 16 years. Now, Fitch Ratings, I talked about Moody's, how they just recently downgraded U.S.'s credit rating. Well, Fitch Ratings downgraded the U.S. credit rating back in August this year, citing a steady deterioration in the standards of governance, among other issues. Now, Moody's, the last of the major rating agencies to had maintained a top rating for the U.S. for quite some time. It changed its outlook, hinting at the possible downgrade in the medium term. However, it affirmed its long-term issuer and senior unsecured ratings as AAA, so citing U.S. credit and economic strength. So essentially what happened here is Moody's, for the longest time, had maintained the U.S. as a AAA credit rating. And there were no changes up until just recently, how they just downgraded them. I'm sure that they just, that wasn't just something that just happened overnight, but there's a lot of different factors. And I was talking about, with all the problems that were happening, with even this government shutdown and all the things that I just kind of referred to, all those things play into factor, right? When the country has internal fighting like that, and especially if they're unable to resolve things, as quick as they should be, then all those things are, they also they impact us on a whole negatively as well, right? If a government shutdown is just averted in the nick of time, last minute, that's not good. They want to see things a little bit more stable and more protocol, and they want people. They don't like risk. They don't like drama, right? Risk and drama are things that definitely can affect and lead to some of these negative ratings. Now, to sum it up, these three significant credit rating agency firms that I was talking about, Fitch Ratings, Moody Services, and S&P Global Ratings, they evaluate factors, as I mentioned, like a number of different things like government debt, income. We're talking about the gross domestic product, the GDP growth, financial institutions, stability, inflation, and default history. Now, each of these firms uses they're kind of similar in their approach, and they use alphabetical scales, with triple A being the highest and C or D being the lowest. Now, ratings are crucial for governments looking to raise money through international bond markets, which we talked about. A strong rating attracts investors, making borrowing cheaper, while a poor rating can increase the cost of borrowing and deter potential investors, impacting the government's ability to fund various initiatives. Now, this is especially critical for developing countries. Okay, so we talked about the credit rating agencies. We talked about what they do and how they go about determining or being able to quantify a nation's credit worthiness, right? But now let's talk about interest rates. Now, are they actually going to go down? Like, what exactly is the story, and how is this going to be? How is this going to impact us? Now, if you're in a market of, and you've heard me talk about this before in previous videos, but if you're in the market of purchasing a new home, if you're looking to purchase that new car that you've been wanting for so long, if you're looking to get a new any kind of loan for that matter, you obviously know that you're quite aware of the higher than normal average interest rates, right? And obviously higher interest rates mean higher payments. Now, that's making it difficult to borrow for many people. And even if you are on the side that's eligible for that loan, the question you're still questioning whether to proceed forward because of the higher payments that are going to be associated with that loan. And that's all because the Federal Reserve has been hiking interest rates since March 2022 in an effort to cool inflation. Now, you have to understand the Feds have two objectives, right? One is to keep inflation low and to keep unemployment low. Okay, so those are the two big things right there. And in practice, this means that they lower interest rates to incentivize growth and hiring. All right, and raise rates to combat inflation when the country gets overextended. Now, this leads to a policy kind of teeter-totter, right? Meant to balance out the economic activity in the U.S. So the question will actually remain is, when will we finally start to see interest rates come down? That's the ultimate question that everyone's going to have on their plate. And I personally think it's possible that interest rates are going to potentially go down in early 2024. I don't think anything's going to happen. And we're at the tail end of the year right now. And I think it's too early in the new year. So I think sometime maybe third or fourth quarter of 2024 is when we're probably going to start to see lower interest rates. And that's possible, right? Because inflation, as we know, is starting to cool down. And the Federal Reserve's target is at 2%. That's their target that they've had. And as the country starts and the economy starts to show signs that it is cooling down, then it's going to make it at least a little bit more easier to predict. The other alternative is that the rates will be stable or higher through 2023 before slowly coming down in 2024, 2025 to settle at a comfortable 2.5% for the long term. So on one side of the spectrum, there's a lot of people that agree with me that they feel that the interest rates are probably going to come down sometime maybe Q3, Q4 of next year. And nothing's going to happen from now till the end of this year, as we're almost done the end of the year. And some people are thinking, yeah, maybe it's going to be a little bit earlier in the new year. And maybe some people are even thinking instead of 2024, maybe 2025. That's a possibility as well, too. So lower, obviously, at the end of the day, lower interest rates will help make borrowing cheaper. And that being said, you'll generally have to pay less in interest on any new student loans, personal loans, business loans, mortgages. Anything, obviously, as you know, that's associated with the high interest rate right now, existing loans with variable rates may also start charging less interest as the Fed start to lower interest rates. So that's good news as well. So that's why waiting until interest rates come down, folks, before borrowing money for large purchases like that new car that you've been wanting for so long, or maybe even that new home, might actually be easier, and it actually might make more sense to just wait. The current average mortgage interest rate on a 30-year loan right now is 7.98%, even for borrowers with a credit score between 700 and 719. Now, this data obviously is making it very difficult for first-time home buyers and especially for existing homeowners, some of whom are afraid that their mortgage payments could increase in the event of interest rates, climb. Now, just imagine if you got a high credit score between 700 to 719. I think that's pretty good. That's pretty high. And if if the interest rates are still super high, like, it doesn't matter how great your credit score is. I think if you can, and if you can avoid having to make any large purchases right now, then do it. It's better to just be on a safe side. Let things cool down a little bit. Let the interest rates go down a little bit. You'll always be on top anyway if you follow that plan. Now, Goldman Sachs economists are expecting that the U.S. Federal Reserve to begin its interest rate cutting cycle in the fourth quarter of next year, which is later than an earlier forecast that they were talking about the possibility of interest rates being cut sometime in like Q2, and now they're shifting and they're saying, well, no, actually, based on the economic data and all the things that are going on, we think it's going to realistically the interest rates are going to start getting cut sometime in Q4. I kind of feel that as well too, and it's possible. Now, the benchmark interest rates as it stands has not changed, and it's currently still between 5.25 and 5.5% range. However, previous projections and expectations were to see interest rates go down a full percentage point, and now it's expected to drop only by 50 base points, which is like 0.5%. Now, meanwhile, Goldman Sachs and Morgan Stanley do not expect another rate hike for this year. So that I think that kind of makes sense. However, Barclays, B of A, and Citigroup predict that it could get a little bit more worse, okay, before it gets better. So with the Feds potentially delivering another 25 base points raise sometime in the new year. That's a possibility. So if the possibility of interest rates going up a little bit higher, stabilizing, and then potentially going down, I think that's a possibility. So most financial institutions agree that the interest rates will drop next year, okay? But where they differ is how much will they actually drop by. So let's talk about that. So UBS Group, AG, and Morgan Stanley both anticipate deep cuts for the interest rates in 2024 due to the possibility of the economy and inflation also subsequently cooling down. Goldman Sachs, however, expects fewer reductions and a much later start than previously reported, which we just spoke about. Here's where the ambiguity and confusion lie. UBS Group, AG, and Morgan Stanley are on the same page. They feel, and Goldman Sachs, they all feel that the interest rates cuts are going to happen sometime in 2024. And obviously that's because they feel that the economy and inflation is on a trajectory to potentially cool down, and it's cooling down as we speak, right? However, as I mentioned, Goldman Sachs feels like their projections are more towards the latter part of 2024, and that's when they feel that we're actually going to start seeing cuts. Now, there's a lot of ambiguity, there's a lot of confusion because analysts on both sides are trying to make sense of the latest economic data, and it's not easy, and there's no clear path, as so to speak, in terms of being able to identify what exactly is going to happen. Now, U.S. bonds, as I mentioned, they slumped sharply last month, driving yields to multi-year highs, only to rally again this month for the month of November. So UBS sees reductions potentially happening sometime in March, not at the end of 2024. So this is assuming that the U.S. economy will slide into a recession, from the second quarter. Now, if this happens, then this is going to prompt the central bank to cut rates much more than the Feds are doing right now. Okay, so although Morgan Stanley and UBS and Goldman Sachs are all predicting that there's going to be interest rate cuts next year, that's fantastic. That's great. That's exactly what we want to hear. But they all see things just kind of slightly differently, right? So UBS predicts that well, they're projecting there's a possibility that interest rates could happen as early as Q1, Q2. But that's in the event that the country slips into recession. That's not so fantastic. We don't want to see that happen. So Morgan Stanley's team does see a little bit more quantitative easing. They're seeing a lot more issues financially, but they don't see a recession. They do feel that things could get potentially a little bit more of the same, maybe not worse, but still more of the same of what we see now, but no recession. So that could be positive, and we don't want to see a recession. And Goldman Sachs, on the other hand, forecasts are closer to market bets and the central bank. So they're being a little bit more realistic, whereas before they were talking about the possibility of interest rate cuts happening earlier in the year. Now they're talking about maybe later in the year. There's also, on a whole, they're talking about unemployment rate should be peaking at about 4.3% in 2025, whereas the Feds have it at 4.1%. They also feel that growth in inflation will be a lot slower as well too. So no matter how we look at it, I mean, there is a cooling in the market. Inflation is being cooled as well too. People's purchasing power has somewhat reduced with the high interest rates. So therefore, technically speaking, people shouldn't be buying a lot of big things, right? So it seems like there are going to be cuts, and it's possible that our first cut could be sometime in Q4 next year, with at minimum a 25 base point percentage cut, and then of course, happening every quarter like that until the rates are supposed to settle down to at about around 3.5 to 3.75%. And so essentially this is creating for a soft landing for the Feds, but weakening growth and recession fears are still alive, and they're starting to grow, and you're starting to hear that a lot more in a lot of discussion. So that'll be interesting. We're going to definitely follow this news. I want to thank you guys for taking the time to listen to this video, watching this video, and if you guys want to hit the like and share, that's definitely going to help us as well, and subscribe, so we're going to definitely share more content with you. Thank you again, guys. I hope you guys have a great rest of the day, and we'll catch you on the next one.